Hello all, welcome to this session on barrier options. We will start with understanding the concept of what exactly is a barrier option, what is knock-in, knockout, and then we will understand the different types of barriers. And then we will also look into one of the practical example of a barrier option. And then in the later part, what we will do is we will see how practically these options are traded. And we will also focus on certain trade economics, the fields which are used for booking barrier options in the system. Now, usually barrier options are traded in OTC derivative market when compared to vanilla options. So let us understand the difference between a barrier option and a vanilla option. Now, this is a simple vanilla option where the holder will pay $10. We call them as we call it as a premium, and the strike rate here is 100. So assuming this particular share, RBC share, goes to 350, the holder can receive 250. That means whatever the appreciation happens above the strike price, that much money the writer will have to pay. So the holder will get a cash flow of 250. Now the holder has paid 10. So the holder makes a gain of 240. So this is in case of a call option. Now in case of a put option, assuming the strike price is 100, the holder has paid 10 and the share price comes down to $30. The holder will receive 70 and the holder has paid 10. So his net gain is 60. So in a vanilla option, the holder will always have a limited risk and a potential profit. Now this can become very risky for the writers, especially in Forex market. So in Forex market, what they do, they create products like knock-in, knockout. These kind of barriers are added to the options. Just to give you one example here, the writer, in order to reduce the risk, may put a condition called as KO, that is knockout. He will put a condition that if the price breaks above 250, the option will become inactive. That is, the option will become deactivated. The holder will not receive anything apart from rebate if applicable. So if the share price from 100 goes to 240, in that scenario, the holder will get 140. But in case if any point of time, if the price goes about 250, this option will become deactivated. That means the holder will not receive any payoff. Whatever the premium he has paid, that money is gone. But in certain scenarios, the writer may give an amount called rebate. So we will have a practical understanding of that by looking into one of the examples. Now, what is this is called as knockout. Now, there is also a concept called knock in. So assuming that you buy a put option at 90 and you pay $10 at a premium of you pay a premium of 10, the strike rate is 90. The writer puts a condition that before this option becomes active, the share price should touch 110, then only the option will become active. So you pay $10, the share price from 90 directly dropped down to 30, you get zero payoff because the 110 barrier was not touched by the stock. Assuming the stock goes from 90 to 110 and then goes down to 30, then you will be getting this 60. So we call it as a knock-in. So when we look into a trade capture system, you'll get a fair idea how these conditions are incorporated in the barrier options. Now we have recorded some videos on how call option and put options are traded. We will be sharing that in the description. You can uh, watch it if you do not have the understanding on call and put option. Okay. Now let us understand some of the concepts with regard to barrier options. Okay. So when we say barrier options, if the underlying asset price breaches a barrier level, it can get activated or it can get deactivated based on the type. That is, there is a concept called a knock-in. The price goes and touches a certain point, then the option contract will become active. If the price breaches a certain level and the option becomes deactivated, null, void, then we call it as knockout. So typically when we are booking a trade with the counterparty, when we are entering a trade with the counterparty, we will put a condition called call option up and out. That means if the share price breaches the barrier level, that call option contract will become null and void for the holder. Down and out. We will set a downward barrier, and if the price touches that level, the option will become null and void. Up and in. So we set a level like 110 for a put option. If the price touches that level from the current level during the life of the contract, then the option will get activated. Down and in. That means for that option contract to get activated, it can be either call or a put. It should touch a lower level and then only the option will get activated. Some of the points that you have to remember that these barrier options are mainly used in the OTC market, and usually barrier options premiums will be cheaper than the vanilla options. So let us understand some more concepts over here. So here is the first example of a knockout level. So assuming the strike price is 100 and the price of the knockout level is 80, and currently the share price is trading at, let me put it here. So you have strike price at 100. The current market price of the stock is 90 and the knockout level is 80. So you have paid $2 as a premium, and by any point of time during the during the life of the contract before the expiry date, let's say the share price touches around 76, you will not get this you will not get any payoff. Whatever the $2 that you paid as a premium, that will be retained by the holder. Now, assuming the stock price was 90, it broke the strike price 100, the price went above the strike price, that means it became say in the money. But during the life of the contract, it did not come below 80. Okay, it did not come below 80, nor during the expiry it has gone above 100. That means here there are three things that's happening. First, initially, assuming it's a European option, the price went above the strike price. That means it became a in the money option. And later it came down. It did not break the knockout level. The option was active, but on the expiry, it did not break the strike level. So the holder again will not get anything. He will lose the $2 which he has paid as a compensation, as a premium. The $2 what the holder has paid, that will go. Now, third scenario you can see here, the stock The initial level, the stock was above 80, then it broke the strike price. It did not come below the knockout level. That means the option is still active. And assuming that it closed at 140, the holder can expect $40 cash flow minus $2 which he has paid as a premium. So the holder here makes a gain of 38. So this option remains active. Now in put option, let us say in a put option, the share price has to share or the underlying asset price needs to come below the strike price for the holder to make money. So assuming the initial level was around 110, the strike price was 100, and the knockout level was 120, the stock during the life of the contract broke the knockout level, this option will become inactive. Then in the second scenario, you can see the stock never touched the knockout level, nor it came below the strike price. This will also end up as out of the money. Now, in the third scenario, the stock did not break the knockout level. It kept going down. Let us say from 100, from 110, it has come down to 50. The holder can get a cash inflow of 50, and assuming he has paid $2 as a premium, he makes 48. Okay. Now, here there is a concept called rebate. That is, you pay a premium of $2, and during the life of the contract, if the option hits the upper barrier or the lower barrier, the writer will refund certain percentage of the premium, which is pre-agreed. We call it as a rebate. Okay, so assuming that the rebate was around 50 cents, in that scenario, as soon as the knockout happens, the holder will get a rebate of 50 cents. So the holder paid to, he receives 50 cents. So as a result, the holder's loss is only $1.5. Now, does all the barrier options have the rebate condition? No. In OTC market, these conditions are negotiated between two parties and then they are recorded in the books. Okay, so let us now look into an actual example here. So here we are taking the hedge fund has appointed a trader who interacts with the John Walter, who happens to be the salesperson. Uh, so the John Walter sends a trade, the trade gets executed, and then they get a confirmation like this. So here the hedge fund has entered into a call option. Okay, they have entered into a call option, and the barrier type here is knockout. That means if the price of the USD, Euro USD, the underlying asset is Euro USD. If the price of Euro USD, let us do one thing. Let us look into the chart here. So currently you can see the Euro USD is currently trading at 1.04. So the hedge fund is expecting it to go up, and they're not expecting it to breach this 1.10. So they're buying a call option here with the strike rate of 1.05, and let us see what is the premium they're paying. Now they're paying a premium of 14,000. So usually in FX market, we don't write premium per euro or a per dollar. It will be based on the total contract value. That means the hedge fund has a right to take 1 million euro by paying 1,040,000 USD. That means if I enter into contract today, I have the right to take the euro from the counterparty at 1.05 even after the price going to 1.09. That means I'm locking in the price at 1.05. So usually what we do, we put a conditions here stating that notional amount 1 million euro, we will pay 14,000 USD, and the strike rate is 1.05. The barrier level is 1.10. Now, any point of time, if the barrier gets broken, then the hedge fund will not get the payoff. They will get a rebate amount of $6,000. So here is this working. Euro USD underlying asset, 1 million euro is the notional amount. Strike rate is 1.05 and the barrier is 1.10. We have paid a premium of $14,000. And in case if the barrier gets broken, we get 6,000 as a payoff. Now, assuming this is a European option, on the expiry date, Euro USD rate was around 1.03, which is below the strike rate. We will treat it as out of the money. We lose 14,000 as a premium. Assuming the price is 1.04, again that is also out of the money. We lose the premium. Now, assuming it goes to 1.06 on the expiry date, we are in a gain of 1 cent into 1 million. That will translate into $10,000. So we will receive a payoff of 10,000 and we have paid 14,000 as a premium. So we have a loss of 4,000. Now, assuming it goes to 1.08, in this scenario, we will receive, we are in a gain of 3 cents, which translates into $30,000. So $30,000 minus 14,000, we are in a gain of 16,000. Assuming it goes to 1.09, we are in a gain of 26,000 because we will receive 40,000. The premium paid by us was 14,000. That means we made a gain of 26,000. Where it gets interesting is 1.10. Once the price touches 1.10, which happens to be the barrier level, the option gets knocked out. The holder will get a rebate of 6,000. Okay, so this is how basically the barrier options work in the market. Now let us do one thing. Let us book this trade into the system and see how it works. So typically we have this trade capture system, like the hedge fund picks up the phone, speaks to a broker who will execute the trade, and then they send the confirmation to us telling that the trade got executed. So here we will have to capture who's the counterparty for the trade, then what date the trade was done, when is the trade getting booked in our system. So all these are required from the accounting point of view and as well as for settlement. These trade economics are very important. Now, remember, when you look into the system, OTC, assuming that you're going to use any of this front office system, there will be two types of options, single barrier and double barrier. So in single barrier, you'll just have one barrier, like it may be upper barrier or a lower barrier. Whereas in double barrier, you will have two barriers, one on the upside, another one on the downside. So for this example, I have picked up double barrier. So we are not going to trade in a single barrier. We are going to trade in double barrier Euro USD option. So underlying asset is Euro USD. Now base currency is Euro. The notional amount, that means the hedge fund is entering a contract saying that they want to take 1 million euro and they're willing to pay 1,040,000 USD. That is, if you're taking the base currency, you have to pay the quote currency. Okay, if time permits, we will do a recording on how the Forex market works and the terminologies, but you need to have a clear understanding about base currency and quote currency. Now, the type of options here you can see it can be call or put. If I select call, I have the right to buy euro at 1.04. It doesn't matter whether the euro goes to 1.08, 1.09, I have the right to take euro. When I say I, the trader from the hedge fund has the right to take euro at 1.04. So this is most important. The strike rate has to be captured correctly. Then again in options you have like American, Asian, European, Bermuda. So here we are using European option. So when you take a European option, you have to wait till the expiry date, that is 30th June 2025, to get your payoff. Whereas in American option, you can demand the payoff whenever you want. The holder will have the right to exercise it. Now, uh, then basically, like once we book the trade into system on a day-to-day basis, we need to calculate how much is our notional gain or a loss. For that, we need volatility proxy. So here we are using realized volatility. Okay. Now, how are we going to take the price of Euro USD? So the fixing source becomes very important. The European Central Bank, whatever the rate they are going to publish, that we will extract it from Bloomberg and use it. Like for example, here, if you type Euro USD, there are multiple avenues where Euro USD gets traded on the Capital, FXCM and all that. Usually we will be using a reliable fixing source and we will be pulling the data from the Bloomberg. So ECB, whenever they say the Euro USD is trading at 1.08 on the expiry date, when they publish it, that will be taken for the final settlement. Now, which are the holidays that we are going to follow? We are going to follow target for Euro settlement, and for the USD settlement, we are going to use the New York. We call it as the primary business center where the settlement will actually take place. Now, what if the settlement day happens to be the holiday? Do we do the settlement before that or after that? That also we have to agree with the counterparty. So for example, if we say preceding, that means if the settlement day happens to be a holiday, then one day before that we will be one working day before that we will settle the contract. Okay, so there are different types of business day convention. So if you're working on the tech side, you will need to have a clear understanding on that part. So here we will use something called as a modified following. Usually we use modified following. Now, remember I told you that all options may not have a rebate. That is, what if the upper barrier or a lower barrier is breached by the Euro USD? So here you can see the upper barrier is 1.015. Sorry, the lower barrier here is 1.015 and upper barrier is 1.12. So this is how it becomes a barrier options. So here in our case, I'm going to draw the upper barrier and lower barrier. So this is the upper barrier and this would be the lower barrier. And we need strike rate. Okay, so let us change the color of this. You'll get a clear understanding. Okay, so by 30th June, if the price of this particular call option goes to 1.09, then 0.04, that is 4 cents into 1 million will be paid, will be received by the holder. That will be the cash inflow. Assuming the price goes down, then this will become out of the money. The holder will not get anything. Assuming the price goes and touches this lower barrier before the expiry, then the holder, that is a hedge fund here, will receive $6,000 as a what's the rebate amount here? Okay, let's say the rebate amount is around 6,000. So they will receive $6,000 as a uh, compensation. So $6,000 will be received as a compensation, and you can see here 14,000 is the premium. Okay, now, so we usually, whenever we are booking the trade, we also need to capture in which currency are we going to pay the premium. So premium will be paid in USD, that is $14,000, and the rebate amount is also paid in the received in the USD. So I think all of you now got a clear idea how we are capturing it. So here you can see so what we do is basically here we have to type the type of the barrier. This is the most important. You can see double knockout. That means it has to breach the if the lower level gets breached or it breaches the upper level, then this option would become inactive. That means the holder cannot receive the payoff. He will be entitled only for the rebate amount. Now, what we can do, we just want to add one condition, that is down and out. That is, in case if the if the Euro USD price comes below 1.01, then this particular option 1.015, if it touches, then this option would become deactivated. This option contract would become deactivated. Up and in, like you want to start this contract with inactive status and then you want to activate it. That time what we do, we don't put anything in the lower level, we just put the upper level. That means this option will become active only when 1.125 gets breached. So let us look that here in this example. So the strike rate is 1.05. You have paid around $14,000 as a premium. Assuming the USD INR closes at 1.09, you will not get anything because this option is still inactive because it has not broken 1.12. Assuming the option breaks 1.12 and then comes to 1.09, then you will get a payoff of around $40,000. So like this, the options will have their own conditions like barrier options. You have to remember these conditions, double knockout, down and out, knockout. Knockout means the option is knocked out. So basically it starts as active and then if the level gets breached, either upper level or a lower level, then it gets knocked out. So those kind of conditions are added here in the barrier level. Now, also monitoring type is very important. Usually once the trade has been confirmed by the both the parties, either the clearing house or one of the agreed party, they will be continuously monitoring the underlying price. So whenever this particular price breaks 1.12, they will basically terminate the contract telling that it was a knockout event. So that monitoring type is either it can be continuous or a discrete. When we say discrete, they will be monitoring the prices at a particular time period, not regularly. Whereas in continuous, whenever the markets are active, they will be during the business hours, they will be monitoring it. Then can the barrier be shifted? Let's say you start with a barrier of 1.01. Can the barrier be shifted? Yes. There are some complicated products where they have a provision to change the barrier based on the underlying volatility. So here in our case, there is no barrier shift. We will put it as not applicable. Okay. No adjustment. We'll put it as no adjustment. Then so like this, the details of the trades will be captured in the system. So the most important thing that you will be capturing is the premium amount, the rebate amount, the type of the barrier, and this FX rates are also very important from the valuation point within our internal system. All these details are captured within the system. Now, just to give you a fair idea, what are the other types of OTC derivative products are there? So there are multiple OTC products. Like in FX market itself, you have these many types of options. In equity swaps, very popularly, total return swaps, contract for difference, various swaps, volatility swaps. These are used by the hedge funds. And then based on the credit risk, it can be used for hedging, like credit default swap or a credit default index swap can be used. Interest rate swaps are used both by banks and hedge fund. For hedge funds use it for speculation, whereas banks use it for hedging their risk. That is to maintain the asset liability balance. They basically enter into the interest rate swaps. Then inflation swaps are used by these pension funds and asset management companies. That's also very actively traded. Then there are property related swap contracts. Commodity swaps are very actively used for speculation as well as hedging. And then longevity swap, it is based on the mortality rate of the individuals are used. So in case if you are interested to work in a hedge fund front office as a trader or a bank's trading desk, having a thorough understanding about all this product would be essential. That too, if you are a finance or an engineering graduate who is a resident or you have a work permit to work in USA, Europe, Singapore, or a Middle East, then understanding of this product would help you in your career. So we have planned a 36 hours online training, which will be a live training where we will take you through the list of all the products, and we will show you the live demonstration how these products are booked in the system. So you get a fair idea like swaptions, FX swap, and all that security lending and borrowing, which is used for short selling. All that you'll get a fair understanding. Now, also to work in hedge fund, understanding the role of the prime broker, custody services, and security lending and liquidity management is also very important. That also we will be covering in this 36 hours. So you can follow us on the website, LinkedIn page that is called Watson and Wells. You can write a mail to us at watsonwells21@gmail.com if you have any queries. And hopefully all of you got a fair idea about barrier options. Thank you.